Oil prices swing wildly on speculation, weather, and geopolitics, leaving investors scrambling to predict tomorrow's direction. This research asks a fundamental question: can artificial neural networks crack the code of short-term crude oil forecasting, and do futures prices hold the key? Let's start by understanding why this forecasting problem is so difficult. Building on that challenge, the authors identify several key obstacles. Traditional fundamental variables simply aren't available on a daily basis, making short-term forecasting especially tricky. Meanwhile, the crude oil market responds to an unpredictable mix of political shocks, weather patterns, and speculative trading, creating a highly dynamic environment where accurate 1 to 3 day predictions become essential for managing risk. So how do the researchers tackle this complex prediction task? The authors design a 3-layer feed-forward neural network. Starting with a benchmark that relies solely on lagged historical spot prices, they apply sophisticated preprocessing, transforming raw prices through momentum and force equations derived from relative changes, then smooth the data with a 3-day moving average filter to reduce market noise. Their methodology balances 3 critical training objectives against multiple evaluation metrics. On the left, they ensure the network converges properly, generalizes beyond training data, and produces stable predictions across multiple runs, while on the right, they track hit rate as the primary success measure, supplemented by standard error metrics and the information coefficient to assess signal quality. To test whether futures prices contain predictive information, the researchers gather over a decade of daily WTI crude oil data. They systematically add futures contracts at different maturities to the benchmark model, testing each individually and in combination, using a 90-10 train-test split to ensure robust out-of-sample validation. Now let's examine what the experiments revealed. The results tell a nuanced story. The benchmark model alone reaches nearly 78% directional accuracy out-of-sample when using 13 optimal lags, demonstrating that historical patterns carry substantial predictive power. Adding futures prices does provide new information, particularly from near-term contracts, though the improvement over the benchmark proves modest, suggesting that while futures matter, their incremental benefit is limited for these short forecasts. The authors candidly acknowledge their findings' boundaries. While futures prices add information, the gains are incremental, and the daily closing price data may miss important intraday dynamics in the spot futures relationship. They suggest that incorporating additional market variables and exploring intraday patterns could unlock further forecasting improvements. This research demonstrates that neural networks can successfully forecast short-term crude oil price direction, revealing that futures prices carry predictive signal, even as historical spot prices remain the dominant information source. To dive deeper into this work and explore related research on commodity forecasting, visit emergentmind.com.